Time to check in on the markets. Chinese equities led stock market declines in Asia, with weakness also evident in European markets. The downbeat mood emanating from the China contrasts with the boost in sentiment in global markets last week after the Fed meeting minutes showed that most officials were backing slowing the pace of interest rate hikes. All eyes will be on the U.S. jobs report this weekend on Fed Chair Jerome Powell, as well as New York Fed President John Williams, who are among some of the central bank officials scheduled to speak. Locally, Barloworld's car rental business, which will be unbundled and listed on the JSE next month on December 13th, will have a valuation of 4.5 billion rand. The business houses the Avis and Budget rental brands, with Barloworld shareholders receiving 1 Zeda share for each Barloworld share that they own. The spin-off is a rare boost for the Johannesburg Stock Exchange, which has been struggling to attract listings in recent months. And as we've been talking about what is happening in terms of the Chinese protests regarding the strict COVID situation, let's have a look at what's happening with the oil price. We are seeing the Brent crude price trading right now at around $81.39 a barrel. This after diving more than 3%. In the earlier session, we did see it traded around $80. It's the lowest since early January, and this comes as protests in top import to China. Again, the COVID curbs are fueling demand concerns, while investors remain cautious ahead of an agreement of a price cap on Russian oil, as well as the OPEC Plus meeting. But let's just giving you a sense of what has been happening over the past 10 days. When we look at the oil price, we did see a little bit of scaling back as investors had hoped that the COVID-19 measures in China could boost Chinese demand, especially when we start seeing a bit of a scaling back. But it was also the looming curbs on the Russian oil shipments that were also affecting the tight supply. It's been a bit of a journey, and let's switch to a one-year chart just to give you a sense of what I mean here when I talk about that journey. Oil prices trading at around $130. It's a far drop, and this was as we've seen interest rate rises as well as COVID lockdowns in China raising concerns, and that's why we're seeing that fall from $130 where we started in the beginning of the year, around $127 a barrel just before the Ukraine invasion. We saw oil climbing, boosted by the embargo on Russian oil. This was at around March of this year, and that was not seeing any signs of abating. But if we go back to about probably last year, this time, we had oil prices settling at around $72 a barrel. And the reason we were at that particular price was that we had investors concerned about the demand outlook, and at that particular point in time, we had a new variant called Omicron variant, which the World Health Organization had basically dubbed as a cause for concern, with a lot of the investors concerned about the fact that it could cause a bit of demand destruction. However, we are looking ahead to that OPEC Plus meeting December 4th taking place this weekend. There have been discussions about increasing the amount of production to about $500 a barrel, 500,000 barrels per day. But we'll see how that unfolds. But nonetheless, to talk to us about the latest when it comes to the markets, we are joined by Gary Boyson, who's a portfolio manager at Rand Swiss. Gary, thank you so much for your time. Your sense of global market sentiment, given the visuals that we're seeing coming out of China, given how the markets have reacted on that particular front?
I think largely the markets are taking this in their stride. There's no question there's a little bit of a risk-off sentiment feeding into the markets, and we're seeing that in the all-share index down around 0.25%, mainly being felt in the resource index, which is down over 1%. In the industrial index bucking the trend totally, up about 1/3%, and that's largely because AB InBev was upgraded at JP Morgan with almost a double the price target. So we're seeing that stock up around 4%. But as you mentioned, if the market was really concerned about what these protests mean across China, and kind of been listening to analysts all morning discussing the implications for the Chinese authorities in Beijing, I think you would see more of an effect. So we've got the gold price up marginally, a typical safe haven, but we've actually got the dollar index, trading down, below 106. So the rush to safe havens is certainly not happening. Like I said, mild risk off, but this is also coming after a month and a half of a very, very strong rally. And I think the market is probably more interested at the moment in what's going to happen with the non-farm payroll number on Friday, and obviously the all-important interest rate hike from the Fed mid-December.
Right, before we even get to that, I mean, let's stick with the China theme. Foxconn offering a $1,800 bonus to workers who stay on at their iPhone city. I mean, when you consider the disruptions in China, both from a production and demand standpoint, how much of that has impacted your forecast, especially when it comes to some of these tech giants?
I think a lot of the tech giants are feeling a multiple unwind rather than anything to do with their actual change in revenue or change in earnings. So if you look at Apple specifically, just the unrest at the specific central Chinese production facility could potentially see global production of iPhones drop by about 10%. Apple has already warned this, so some of this is already in the share price, but we are seeing Apple trading down around 1.4% in pre-market trade. So certainly the unrest that we're seeing at the moment is having an effect. Foxconn obviously offering those $1,800 bonuses to try and get workers back to work. But this is, again, it's something that's already in the market. This has been going on since mid-October, where factory workers have been concerned about working just under the COVID conditions. So I think a lot of this is in the market. Of course, if you look at specifically iPhone 14 Pro inventories, that looks between 25 and 30% lower going into the December period. And I think everyone's trying to gauge how significant Black Friday was for a company like Apple. But going in with lower inventories into the December period, where you expect a rise in demand, could very well see shortages in iPhone and Apple products. And if that's the case, you would expect to see the impact on revenue. Our forecast of revenue growth for Apple, the next, look, this will likely be a short-term impact. It's a supply chain disruption. I wouldn't expect a long-term issues, but looking 1 or 2 years out, we're looking at low single-digit revenue growth for Apple and the same in terms of earnings per share growth. So I think the threat to the tech stocks, to answer your question, really comes from the elevated PEs. Apple's still trading on a historic multiple of around 24 times earnings. So with earnings growth only coming in, next year our forecast is 2.2%. That looks pretty expensive.
This week we've got comments, or rather speeches, from some of the Fed presidents, New York and St. Louis. To what extent are investors, I suppose, hanging on every comment coming out of the Fed presidents, as well as, I suppose, trading on each pronouncement?
Well, I think I've seen it said that the Fed is still the only game in town, and of course anything that adjusts your expectations around the potential rate hike in December is going to be crucial. So it's not just the Fed presidents, and every Fed president has its own personality and its own, I suppose, measure of dovishness or hawkishness. But we also, of course, have Jerome Powell speaking at the Brookings Institute on Wednesday, and he's going to be giving an update around the economic outlook and the labor market. So I think you could see ahead of the non-farm payrolls just maybe a moderation of the dovishness that came out from the FOMC minutes we saw last Wednesday. Markets certainly interpreted that as very optimistic. If you look at, I suppose, expectations around the rate hike that should be coming through mid-December, there's a 70% probability, according to Fed funds futures, that we'll see a 50 basis point increase, and about a 30% probability that we'll see the 75. So the market's certainly leaning towards that 0.5% increase in the US. And I can tell you just from the expectations when we chat to clients, I think a lot of people are expecting a recovery in equity markets based on easier monetary policy. Of course, everything is always data dependent. So I think that non-farm payroll number on Friday is going to be absolutely crucial. And what the Fed speakers say today is also going to be incredibly important. Any shift in those expectations, and we're going to see that playing out across bond markets, equity markets, and currency markets.
Gary, unfortunately, we've run out of time, but I would have loved to, gauge your perception in terms of as we talk about the possibility of a recession in the US, what the telltale signs for you would be if we were to see a recession. But unfortunately, we'll pick up that conversation after the non-farm payrolls and hopefully definitely have it just before that December 14th Fed meeting. But that's it from Gary. Let's leave it there. However, we're going to be taking a quick break. When we come back, we'll have more news for you, so stay tuned for that.